Can everybody hear me? Okay.
Yes.
Good deal. So my name is Aaron Skank. I'm an insurance agent for Farmers Union up here in Moorhead, Minnesota. Just a little bit about me. I grew up on a farm outside of Hawley, Minnesota, smaller town, a couple thousand people, but just for reference, it's east of Moorhead, about 20 miles, right on Highway 10. I attended NDSU over in Fargo, graduated with a degree in finance and agribusiness. I worked at Bell Bank through college. The plan was to get into ag lending with them after I graduated, but went to a career fair a couple months prior to graduation, and I ended up interviewing with a company called Rain and Hail, crop insurance company, one of about 15 in the United States, and they were offering me a company car and a company phone and a salary, so it was pretty easy to switch career paths and jump on that. So I spent about 8 years with Rain and Hail. I grew up on a farm, corn, soybeans, wheat. We had dairy cows for a while, switched to beef cattle. I knew crop insurance was a thing, but that was about the extent of it. It's just not really an area that a lot of people spend the time in. And from my understanding, everyone on this call is pretty heavily involved in agriculture, but is it fair to say that crop insurance is not something that's actively talked about among this group?
Well, Aaron, it is, but remember I said we couldn't swear. So for the folks that we work with, we don't believe there's any product that really works for us. We could be wrong, but that's where I would tell you that's where we're sitting at.
Sure. So yeah, after 8 years on the company side, my role was to recruit new agents, try to get agents to sell for Rain and Hail and not the competitor. Like I said, there's about 15 roughly different companies who offer crop insurance in the United States, and that number fluctuates with mergers and all that good stuff. But part of my role was also to train new agents. So every year I would put on a 6-hour crop insurance one-on-one course. So I'm going to do my best to take that 6 hours and smash it into about 45 minutes and then kind of have an open discussion. So I'll try to keep it relative to this whole farm revenue protection product, the microfarm product that's new for 2020. One thing I learned at my time with Rain and Hail, and have come to realize even more sitting on the agent side of the desk, that crop insurance is very, very unique compared to all other lines. For example, not in every instance, but in most instances, if we're talking about a homeowner's policy, an auto policy, one of the most important driving factors, and if you sell that, is going to be the rate, right? Who's got the cheapest rate for the best coverage? Crop insurance doesn't work like that, being a federally funded program. So there's no difference whether that farmer takes out a policy with me and Rain and Hail or NAU or Farmers Mutual. Those are the three companies that I write for. Or they go down the streets to the other agent who sells for RCIS or Armtech or anybody. The same policy is going to cost the same dollar amount, no matter who you buy it from. It works the same from essentially the contract standpoint. So me as an agent, I get appointed, licensed with one carrier, two carriers, and then I can sell policies on their behalf. So me as the agent, kind of the middleman between the farmer and the insurance company, and ultimately RMA and USDA. So with that being said, so can everybody see this Rain and Hail slide that says insurance cycle? Okay. So I just want to kind of give you a base understanding on how the timeliness of crop insurance in general works. It's not just like I said, a homeowner's or an auto policy where if you buy a new home on June 1st, you can get an insurance policy based on that. There's very specific deadlines. If the right paperwork is not completed by the proper deadline, it has serious implications on coverage. And in some cases, if certain deadlines are missed, there's just not coverage in place for that calendar year. So if we look at it in a calendar year standpoint, we would kind of start it, let's say this is January 1st, okay? So in crop insurance, from the beginning of the calendar year, January 1st to March 15th, we're kind of in a training and changes state. So between today, essentially, and March 15th, me as an agent, all the farmers around the state of Minnesota, you have to make all of your changes for that year, any new entity changes, anything like that, any new policies, if you're adding any crops, all of that has to be done, signed, sealed, and delivered by March 15th. Whole farm revenue protection, microfarm policy is not any different. So as far as deadlines are concerned, if there's one, the next deadline we're really concerned about is that March 15th. We've got to have everything filled out and applied for by then. So that's what's called sales closing date. So after sales closing date, we kind of get into a period where, okay, coverage is in place. We know what crops we want to insure. We know what programs we want to be in. As soon as that crop is planted, coverage is attached. So whether that's April, May, June for some of our crops, as soon as that seed goes in the ground, it has coverage on it. Come July 15th, all of the farmers would have to both go and certify at the FSA office, give them what was planted by farm track field number after or before. This can go either way. The general consensus, what most people do, they go to FSA, they certify, they go and meet with their crop insurance agent after that and report their acres to the crop insurance policy. So that would be the acreage planting reporting dates. Based on that information, the company will issue a summary of coverage. We have the billing go out, the agent collection. So now we're looking at that August, September, October timeline. Any claims that need to be worked at that time of the year, claim payments, and then come about the middle of November, end of November, we're rolling right back into trainings, updates, farmer meetings for the next sales closing date. So it's a little different from a calendar year versus a crop insurance year. We've got major deadlines, but they don't really fall on any typical dates. So March 15th, sales closing, July 15th, acreage reporting, and then we kind of see how the year plays out if we need to have any claims adjusted. So what does an agent do? Agent identifies risk, explains the products and options, probably your most important job. Sell the insurance contract, collect production and acreage information. So the agent is the one directly taking that from the customer. We would notify any company of any losses, inform the farmer about changes to the program. Again, that's one of the most important jobs of an insurance agent. What does the company do? So by company, that means Rain and Hail, RCIS, any one of the 15 people appointed to sell crop insurance. They insure the contracts, provide the processing of paperwork. So me as the agent, I process it all in whoever's system on the computer, whichever company has that policy. Insurance claims are fairly and promptly paid, accepts risks on the insurance policy, interacts with RMA agents and farmers, and the company would train me as an agent as well as their adjusters. So it's a private public partnership. So essentially the private companies are issuing a public program. So the federal government is involved to the standpoint that they subsidize the insurance policies. Every private, non-private product, every policy that runs through the multi-peril program, the USDA program, is federally subsidized. The subsidy percentage is different for individual policies individual coverage levels. And I have a slide coming up that kind of gives you a little picture of what that looks like. Why is it a government program? Weather tends to impact a very large area. Without federal subsidy, premiums would be too high. So that if this wasn't a subsidized program, the farmer participation would be a very small percent of what it is right now. Just because if you look at a typical crop insurance policy, that farmer paying the bill is really only paying 30 to 60% of what it actually costs, depending on what product they go with. So the federal subsidy comes in a huge way to make this more affordable. Just kind of the basic, again, structure of how these policies are issued. I'm going to jump here to slide 80. Again, this is about a 700 slide crop insurance 101 slideshow, so not something we want to go through every slide. So I kind of alluded to the subsidy factors and let you know that they change based on the coverage level you've elected, and also which policy you have. So there's a number of different unit structures, a number of different options, a number of different coverage levels. What the subsidy factor that farmer gets all depends on where they fall on this grid. So this is kind of, I would say, a sweet spot for a lot of farmers is an enterprise unit at a 75% level. It's a pretty common policy. You can see the subsidy factor is 77%. So I'm not the best at math, but that farmer is paying 23% of the actual cost of that policy at that level. And it's 75% is a pretty decent level to insure at. That's a pretty good subsidy. This is where a lot of our farmers fall, at least where I'm at. Southern Minnesota, there's a lot more insuring at this 80 and 85% level. Not really up here. Slide 81, just basics of crop insurance, and these are generally true for the whole farm and microfarm policy itself. So it's a continuous program. Once you sign up, that policy is in place. So if I sign up for a policy by March 15th of this year, and I take no action to cancel it prior to March 15th of next year, that policy just stays in place. So it's continuous until canceled. You must insure all of your acres. So you can't, kind of pick and choose fields. You got one field over here that typically does pretty good. You're growing the same thing in another field over here that does not typically do good. It doesn't work like that. You cannot pick and choose acres to insure. Keep separate production records. Just ignore this by basic or optional unit. In crop insurance and whole farm and microfarm, production records are huge. We have to be able to substantiate that guarantee that's established for your insurance policy. And there's a number of different ways you can do that. The company just needs to see something. Okay, you said you had $50,000 in revenue this year, which is what whole farm revenue protection insures. We're not insuring 100 bushels of corn. It's a total dollar amount, and that's what we would be insuring. The company is going to want to know, how did you come up with that dollar amount? Should put something in front of me that tells me you had $50,000 in sales for this year. All records in this program are subject to audit. That's a pretty common thing to have policies audited. Jump to specifics about whole farm revenue protection. So whole farm revenue protection is essentially the basic product even for this microfarm. So the microfarm, I would say, is kind of an option underneath the whole farm revenue protection policy itself. So the whole farm revenue protection policy provides risk management safety net for all commodities on your farm. So in a farm of corn, soybeans, and wheat, somebody would be insuring their corn separate from their wheat, separate from their soybeans. Each crop is its own contract. Under whole farm revenue protection, we're not really concerned about the individual crops itself. We're looking at a total dollar amount and insuring against that number. Whether you got half of it from one commodity, half of it from another, whether you got 10% of it from 10 different commodities, what we're concerned about is that total farm revenue for the year for all commodities. Coverage levels can go from 50 to 85%. It protects your farm against the loss of farm revenue that you expect to earn from the commodities you produce during the insurance period, commodities you buy for resale, all commodities on the farm except for timber, forest products. So all commodities, right? If we've got 10 head of beef cattle, that is a commodity under whole farm revenue protection. That would be one source of farm revenue. If you're growing 5 different crops, you got a couple head of cattle, that's essentially 6 commodities on your farm. Uh, 129. So to establish a guarantee on whole farm revenue protection, we have to come up with what's called approved revenue. So we put paperwork together, we put sales receipts together, and come up with a farm revenue. So the approved revenue is determined on a report, a farm operations report, and that is what we're going to insure against is the approved revenue. In whole farm, that could be one of 2 numbers. We look at a 5-year farm history. So you would produce records from the previous 5 years of everything you sold, all the commodities you sold on that farm. And then we would also so we take an average of those 5 years. Let's say it's $75,000 was your average farm revenue for that 5-year window. We also put together another report before March 15th that shows what you're expecting your farm revenue to be for the coming year. We take those 2 numbers and compare them, your 5-year average or your this year's expected, and we insure the lesser of those 2 numbers. Now that is a little different for micro farm, similar concept, but for whole farm revenue protection, the baseline product, that's how we determine what we're insuring against. 5-year history versus this year's expected, which number is lower, that's what we're going to kind of base insurance off of for this year. Some general rules. To be considered eligible for whole farm itself, you have to be able to receive federal benefits. You have to file a Schedule F tax form. You must have filed U.S. federal tax returns for each year used to establish that history. So whatever year we're taking into account to build a history for you, there must be a tax return on file for that year. So this is very different than our other insurance products. This is almost insurance by accounting, right? There's a lot of paperwork involved. There's a lot of tax records involved to get this policy into place. So I'm going to jump over to, does that make sense? I'm trying to keep it.
Yeah. Yes, Aaron.
To whole farm. Is there any questions at this time or open discussion? I've found we can kind of uncover some things that maybe I wasn't even going to cover with questions or anything like that.
Yes, Aaron, we have 2 questions for you. What happens if a farmer doesn't have a 5-year history? What happens if a farmer doesn't have a 3-year history?
For micro farm, 3 years is the baseline. And whole farm itself, 3 years is the baseline. If we don't have a 3-year history to establish a guarantee, this is not an option for them right now. So if we're in that situation, we have a new farmer, brand new this year, we're really going to have to look at the big picture. Okay, is this something you're going to need coverage for? Is this something you are going to want to look at? We got to start getting the accounting straight kind of from, day one. So when we get 3 years of history, we're ready to show those sales records to come up with a guarantee for the insurance product.
And the next question is, would a corn, soybean, wheat farmer ever do the whole farm revenue protection? Would they ever choose that option, or would they stick in their lane and take corn? Or I don't know.
Yes and no. How's that for an answer? No, traditionally our larger commodities, they have kind of tried and true programs that have worked for them over the years. They can insure each crop individually. They can insure each crop at a different percentage level. So if they were to move to whole farm, they'd kind of be taking that away from themselves, right? Because it's a one overall farm revenue. You don't have that individual coverage on your soybeans versus your corn. You could get, a hailstorm that takes out half of your soybean crop, but you had a bumper corn year. So your dollar revenue is there. You had a loss, but the corn made up for it. So you can kind of grow yourself out of a loss if you're not insuring the individual commodities. There's a way, and some people have done it. It's not extremely popular, but those corn, soybean, and wheat farmers have chosen to insure under both programs. So you could take out your typical corn, soybeans, and wheat product that you've taken out for the last 15 years. You could also purchase whole farm revenue protection as an umbrella over all of your revenue. Now that gets pretty complicated because the general rule of insurance is you can't be paid for the same loss twice, right? So there's reductions in payments on the whole farm side. If a farmer got $50,000 payment on his corn, that $50,000 goes to the total farm revenue. So it kind of counts against you on the whole farm side of it, if that makes sense.
We have another question, and then David's got his hand up. Sarah Golden would like to know, could you describe a typical whole farm customer? She's noticed there are lots of fruit farmers in the program.
Yeah. From when I worked for the company, we had different divisions around the country. So I worked for the northern division, which was both Dakotas and Minnesota and Wisconsin. Whole farm was not, to that company's book of business. Whole farm was just a very, very, very small percentage of what we were doing. But if you look at our Northwest division, which is out in Spokane, Washington, that was one of their most popular products. And they were insuring apple orchards out there. There wasn't a tried and true program for that. And then whole farm came along and really kind of fit the bill for those guys. How I've always heard it described is the perfect whole farm customer, somebody selling to direct markets, because they can use their actual revenue, right? What have I received for my commodities over the last 5 years versus on our corn, soybeans, and wheat, we're following the Chicago Board of Trade or the Minneapolis Grain Exchange. Well, that might not be reflective to what the farmer's actually receiving if we've got basis involved, if we've got different markets and so on and so forth. So whole farm revenue protection, when it came out, it was pitched to people selling to direct markets, highly diversified farms. So 4, 5, 6 different commodities. The reason for that being the more commodities you have, the higher the discount on the premium is. So if you've got 2 commodities, essentially you're going to pay a little bit more versus somebody who's got 6 commodities, because in the eyes of RMA, you're spreading your risk around a little bit more with 6 commodities. So your insurance should be a little cheaper with that spread of risk.
Next question, David Veneca, you can unmute and ask.
I was just going to confirm, Aaron. So you said that with 5-year history or Microfarm with 3-year history, and you had to have, I just want to confirm, do you need a Schedule F for every year that you're using as history?
Correct.
Okay.
And Dan Mahoney would like to know, for whole farm and microfarm option, are they subject to that AD 1026 NRCS form for the highly erodible land?
They would be. Yep. Any federally funded crop insurance product, that is it's checked on the back end. So it's not something the companies themselves control. They look at the records at the FSA office to see if that is on file. Typically the company doesn't even want a copy of it. They don't care. If FSA says they're in compliance with the AD 1026, then as far as the insurance goes, they're in compliance. So that's something, if we've ran into problems with that if somebody is set up as an entity or an LLC. Like me, if I'm Aaron Skank farmer, I might have gone to the FSA office and done an AD 1026 in my name, but I farm in AS Farms LLC. That entity also needs a 1026 on file. So it's the people as well as the tax ID number for the entity that have to have that on file. And that's a big deal, because if you're found to be out of compliance, you lose the subsidy for any crop insurance policy that you have. So that table I showed with all the subsidy factors, that goes completely out the window if you're not in compliance as far as the AD 1026 is concerned.
Dan's follow-up there was, if yes, then when is the filing deadline for a new customer?
For the AD 1026?
Yes, go ahead, Dan, unmute.
Yeah, I was curious because I know, for conventional crop insurance, there's some filing deadline, but I can't remember what it is. And I was curious if it was different for whole farm revenue and microfarm.
Yeah, I want to say it's August 15th. It was a little sooner and a little more strict, but I think what a new entity can do is file, and I won't remember the form number, NCIS 999 form maybe, that basically says I'm a new entity, I don't have a 1026 on file, but I am eligible to receive a subsidy. I just have not signed the 1026 yet.
Yeah, good to know. My concern was that, customers would maybe need to get into their service centers by March 15th. And as long as that's not there, that's at least they have some
not March 15th. I believe it's August 15th, which is the date we would send out bills. So that would make sense to get the billing straight.
All right, that concludes the questions at this point. David, your hand is still up. I'm assuming you just didn't click the button or do you still have another question?
No, you're right, Kathy. I'll take it down.
Good job. All right, go ahead, Aaron, you're on.
Okay. So I'm going to kind of switch over from a rain and hail specific, 101 PowerPoints. These are the slides that it helps to still kind of know people in the company. I would say I got this from my old manager yesterday, because I have been to 2 now crop insurance updates that the company puts on. So that's part of that training period. All the agents go to update meetings so they can go then and inform the farmers, right? So I have been to 2 of those, and maybe 7 minutes combined of both of those meetings was spent on the microfarm product itself. So it's not, I would say, a hot topic as far as the companies are concerned on training. So this is not atypical for a new product that comes out. We come up with what we think is a sound product, what we think are good rules. We let people, agents, farmers poke holes in it. and then we kind of revamp it next year. That seems to be the way it works with every brand new product. So not going to have all the answers. Even the company isn't going to have all the answers. If we have very specific questions, it's a very real possibility that that has to make its way all the way up to RMA directly for clarification, because this is brand new, and what they put out in their literature, you know, might not have been the way they actually intended it to be. So these are straight from NCIS, because the company PowerPoints I got just did not have very much on this. So Microfarm Basics, we kind of already hit on that. You have to have 3 consecutive years of tax records, including a lag year. Normally in whole farm, we're not concerned about the previous year. There's a lag year, and then we look at that 5-year period before the lag year. For Microfarm, that last year is important. So if they have not filed their taxes by the time they are applying for this insurance policy, March 15th, or even before, we have to do a substitute Schedule F based on their sales records from the previous year. So normally in whole farm, we're not worried about essentially 2021. Microfarm, we want to know 2021 numbers. It's available to people with allowable revenue underneath $100,000. So their total farm revenue has to be less than 100 grand. There's no expense reporting for Microfarm that there is in whole farm revenue protection. Essentially, if you have a whole farm revenue protection policy, the baseline policy that you're not electing Microfarm on, at a certain point, you have to prove to the company that you put in adequate inputs. So there is expense reporting. They want to know what your cost was for seed and chemical and all labor and all that stuff. So you can't just have a really high insurance guarantee, not really care about this year, not put a whole lot of effort into it, and expect to collect a claim. So Microfarm does not need to report expenses. The baseline product whole farm, they do. There's only one commodity code. So I gave the example, if somebody's growing 5 different commodities and they have cattle, that would be 6 commodity codes on the whole farm policy. If they elect Microfarm, that is their commodity code. Microfarm itself is a code. That gets them eligible. That code gets them eligible to insure at the highest level, at the highest commodity discount as well. So it's not hindering them that it's only one commodity code here. It's actually helping them that they don't have to say $10,000 is coming from this commodity, $15,000 is coming from this commodity. They do and they don't. They have to come up with that for our total number, but we don't have to break it down as much as we do in whole farm. Just definitions: carryover insured, somebody who had that policy the previous year, it's a big deal there. I already hit on this commodity code. A single commodity code is used to cover all on Microfarm. Consolidated sales records. Again, this is it's an accounting policy. Records are huge. Taxes are huge. So when they say consolidated sales records, what they mean, contemporaneous records that document the sale of the commodities, must provide consolidated sales records to determine allowable revenue on that Schedule F. Excuse me. Unlike whole farm, the lag year is included. Already kind of hit on that. So minimum of 3 consecutive tax years. So if they want a policy for 2022, we need Schedule F for 2019, Schedule F for 2020, and if available, Schedule F for 2021. If not available yet, we have to do a substitute based on their sales records. To be eligible, It's this 10 different times. Again, tax records, approved revenue less than 100,000. Vertically integrated operations are not eligible. So if they're not quote unquote a farmer, I will say they're buying berries and making them into jam. That is not something that can be insured under this state. They have to have dirt on their hands, so to speak. They have to be raising the commodity, not just buying, changing it in some way and reselling.
Aaron, I have
Yeah.
a related question there. So some CSA farms are buying, for instance, potatoes from another farmer and then selling them under their CSA. You would not count that as vertically integrated, correct? Even though that one particular part, it'll still be included in their sales, but they're buying and then selling it. What do you think?
Are they altering that product at all?
No.
Then I would say that is not a vertically integrated
Thank you.
farm. Yep. Required reports. Again, this is pretty big. So coverage under microfarm reduces the reporting requirements under whole farm revenue protection. So there's very strict deadlines which we hit. There's very strict reports that we have to do for whole farm. It says that those reports are kind of laxed under this micro farm. Again, not having done it, I'm not certain that's true yet. I have not filled out a micro farm report, so I would say the jury's still out, to me anyway, about the reduction in reporting required for this. Expenses are not required to be reported. We hit that. So one of the reports, the very first one you have to do is that whole farm history. So that's the immediately, the 3 immediate years as far as Schedule F. So your whole farm history report, that's what we're going to start coming up with an insurable guarantee for the year based off of 2021, 2020, 2019 Schedule Fs. It shows on how we would come up with that. So if we're doing this with less than 5 years, 3 is the minimum, 5 is the maximum. So in this situation, the insured has the following 4 years of allowable revenue. So their Schedule F tax records show 2021, 91,000 in sales, 2020, 86,500, 85,000, 86,250. So to come up with the average revenue, we still are going to use 5 years, even if they only have 3. How do we get to 5? We include the lowest as many times as we need to, so either once or twice to get to that 5 years. So their insured farm revenue, they're based off of their whole farm history report, would be $86,810. That's their average for the last 5 years, based off of adding them all up, including the lowest a second time to get to 5 years. There's an option that they can purchase. There's hundreds of different options in crop insurance. One of them is a yield exclusion. You pay additional premium. They allow you to kick out a low year in that calculation. So if the exclusion were purchased, they could kick out one of the 85,000s, take an average of the other 4, and we'd come up with 87,263 as their average on their whole farm history report. If they only have 3 years, which may be very common, kind of the same situation there. We would plug in the lowest 2 times to get 86,560. If they elect the exclusion, we're only gonna use that once.
David, go ahead and ask your question. It's a good time.
So Aaron, if their average revenue is, say it's $118,000, but they still like the opportunity that's available in the microfarm versus the whole farm in general, can they opt to do that, or does that average revenue being over 100 disqualify them from even applying for microfarm?
I don't know the answer to that specifically. What I do know is that they would cap it at $100,000, their coverage level. Their coverage amount would be capped. So if they're anticipating, on an average year, they have $120,000 in revenue, that's not what we're insuring. We can insure 100% of that number. There's a coverage election anywhere from 50 to 85% that they would elect on that number. So I'm not sure it would be to their benefit to do so, because if you have 120,000 in expected, let's say, they're going to cap it at 100, and then we're going to insure 75% of that number. Well, we've got between $75,000 and $120,000 in revenue essentially not covered, which is a pretty big gap. Farm operations report, again, whole farm history. The next one is farm operations report and expected value. What do you expect to earn in this coming year from the commodities you're going to produce is essentially the next report that has to be filled out. What is the expected value? It's determined by the previous 3-year average of allowable revenue from all commodities on the farm, unless market conditions, commodity mixtures have changed that we need to adjust that total revenue number. So if you've been doing something completely different the last 3 years that would have established you a guarantee, that's not really what I'm going to do this year. That's really the only time the expected value comes into play. What we're forecasting for 2022 would be what we're going to insure against then, not the 3-year history, if we've had substantial changes. Otherwise, we're looking at the 3-year history as far as the number we're insuring against. Commodity count and diversification discounts is something we've kind of hit on already. There in microfarm, the commodity count goes out the window. You have one commodity and it is the microfarm commodity, which gets you eligible for the 80 and 85% levels. On the base policy, whole farm revenue protection, you have to have at least 3 commodities to be able to insure at this level. Microfarm, they consider you eligible to insure at the 80 and 85% level just for signing up for the program. So that is one benefit there. Also, the diversification discount. Like I said, the more diversified your farm is, the higher that discount factor will be, the cheaper the premium will be. Your risk is spread out more. Microfarm policies, they get a standard diversification factor.
Stu, can you ask your question? Because I don't understand it.
Probably because I didn't phrase it right. Aaron, I was just wondering, and this is 2 slides back, sorry, I'm a slow typer, but when you are, say I've made changes to my operation, and I want to rely on that expected value, just confirming my understanding that expected value would need to be lower. I would still need my 3-year average, and I would only be eligible for a lower amount. I couldn't make the case to you for a higher coverage level than my 3-year average, correct?
Now, you bring up a good point. Let me see if there's something in here about if it needs to be adjusted. Here it is. If total revenue is expected to be lower, then the expected value of the insured commodities will be reduced. Well, to me, that means it could go the other way too. If your expected revenue for 2022 is going to be lower, they would adjust it according to such. If it's going to be higher, I don't know the answer to that, Stu, but that's something I can verify with the company.
Thanks.
just jotting a quick note here. Give me 1 second. And again, if they are allowed to increase, the company is going to want to know why. You know, these are very heavily underwritten policies. They involve an underwriter in a pretty big way. So if we've got a history that says $50,000 in revenue, they're giving you 2022 projected numbers at 80, they're going to want to know what's changing. Why are we expecting, you know, $30,000 more in revenue for this year? Post-production and added value, unique to whole farms. So I kind of gave the example, if I'm buying berries and making them into jam, that's considered a vertically integrated producer, not necessarily an option for them. If I am the farmer, I'm growing these berries, I am making them into jam, they're going to give you the benefit of that sale value versus the underlying commodity value, if that makes sense. So if my jam sales are much higher in a monetary number than what the berries are worth themselves, to come up with my guarantee, I can use that higher finished product sales number. The rest of this is just kind of actuarial documents, where to find some of this stuff. There's special provision statements. So on USDA's website is where you can find what's called the actuarials. It's all the state and county and crop data that goes into this program. So you just kind of filter it out, what state, what commodity, what crop, and it gives you some special provisions, available coverages. So it's pretty handy, something I reference pretty frequently. I don't think we've really hit on how a claim is worked yet. So again, completely different than your baseline insurance products. Normally we get a field of wheat that's hailed out. We got an adjuster out there within 5 to 10 days. They're adjusting that loss. Okay, we've got a 10% hail event. Work the claim. Here's your check, Mr. Farmer, for 10% of the liability that you purchased on that field. In whole farm and micro farm, claims are not worked until after that next tax season. So once they file their taxes for 2021, that's when we would know they have a payable loss for last year. So it is delayed. I mean, it's months down the road from that loss occurring to when that farmer has cut a check for his loss.
So to confirm, Aaron, it's basically the differences on their Schedule F. Like that's what you'd be looking at to confirm a loss.
Yep. We guaranteed you this much in revenue. File your taxes. We'll look at the Schedule F. How much did you actually receive? And is that below your insurance guarantee? So and I may be ignorant, but in your guys' situation, you know, if we're looking at fresh market crops, all of that revenue should be accounted for by the time they file their taxes. They don't have a bin full of a commodity on hand like we do for corn and soybeans and wheat. They would in that situation, if they had anything on hand that they had not sold yet but produced in that insurance year, we would have to take an inventory of it and assign a value to it. Just because you didn't sell it and it's not showing up on your Schedule F, you still have a valuable commodity there. So we have to account for that from a revenue standpoint.
Jane, go ahead.
Thank you. Yeah, I would say that it's entirely likely that there could be product left by the time people file their taxes. I mean, we have a number of specialty crop farmers that have winter storage facilities, and they're storing, you know, potatoes, carrots, beets, cabbages, and delivering those throughout the winter. And then also folks that are making jam from
Sure.
berries from their own production, you know, they're going to have that on the shelves for sales throughout the next farmers market season,
Yeah.
for instance. So,
So
yeah,
that
I'd
makes
say
sense.
it's going
So
to be likely.
in those situations, we essentially have to determine a value to what was produced and make sure that gets assigned to the right year. So that's kind of when those detailed sales records come into play, to make sure we're assigning the revenue received to the right year. If it's something, it's in a bin, it's in a storage facility, what we would basically do is send out probably an adjuster to see how much of the commodity is on hand, how much can you expect to sell it for at this time. That's the number we're going to put towards your guarantee. That was your quote unquote revenue, even though it's not sold yet.
David, go ahead.
So Aaron, on the Schedule F, what are you guys most concerned with? Like the single line of, crops produced revenue, or all the way down at the bottom line, net profit from farming?
There's a form that Rain and Hail has, and I can try to pull it up, that basically shows you everything that needs to be pulled from the Schedule F. So maybe seeing that would kind of answer your question. It tells you which individual lines to be looking at, where to pull it, and that goes onto the sheet. So the worksheet that we have would kind of answer that question. It would show you exactly the line items on the Schedule F that we're concerned about.
Yeah, that would be super helpful if you could pull it up.
And Dan, you want to do your question?
Yeah, are there limitations to loss causes? Obviously, other insurance or insurance replacement products look at only, natural disasters. So, if a producer experienced a drift incident that resulted in, lower yield that corresponded with lower income, would that be covered under whole farm revenue and microfarm?
Spray drift is a giant curse word in the crop insurance world, because it is not a good situation for anybody. Because the farmer suffered a loss, the company is not going to pay it. The crop insurance company is not going to pay it because it's not a naturally occurring event. So something like that is not covered. In that situation, they would basically have to go back to the farm insurance carrier. So that farmer should be carrying some sort of liability policy for situations like that.
Okay.
And it's
So
a
then what?
it's a double-edged sword completely. So if their crop completely gets wiped out, they're going to have $0 in revenue for that year. They're not going to have any claim paid. So that's one of the worst situations that can happen in the crop insurance world is spray drift, because there's really not a good way to handle it.
And market fluctuations in terms of, commodity pricing.
Did I tie up, or did we lose Aaron?
I'm still here.
We're still going, Kathy.
I'm still here if everyone can hear me.
Yeah,
I was just
I
wondering.
can hear you.
Okay. Dan, I'm not sure, did you still have a question?
Yeah, I was just following up on that question of market fluctuations and commodity prices. Is that something that's covered under that whole farm revenue? If there's a
Yes,
distinction.
it would be. So, just like the normal Chicago Board of Trade, our corn, soybeans, and wheat, there's coverage for fluctuation in the market price. That's something that's covered. So on whole farm, it essentially works the same. The last 3 years you sold it for this much. Well, that market's no longer there. The value of that commodity has severely declined. You're only going to get half of the revenue compared to the previous 3 years, which is what we based your insurance guarantee on.
Yeah, thanks for clarifying that.
Yep. If anybody else has questions, feel free to talk. There's 8 million form numbers in crop insurance, so I gotta find the right one here. Believe this is the form we were talking about. So it tells you here where on the Schedule F these numbers would be found. So this is just one of a few forms that need to be completed prior to March 15th. If this is a product that the farmer is going to want to look at, and we would also have to give the underwriters a little bit of lead time, because it requires underwriting approval. Excuse me, get my words tangled. So the underwriters are heavily involved in the establishments of the guaranteed revenue based off of this and other reports. So this PDF is something I can email to Kathy and see if she can to get it out to everybody, if this would be helpful.
Sounds good.
Yeah, that'd be great.
What other questions do we have? That was kind of the end of the content that I had to cover.
Aaron, this is Jane Jewett, and I have a question. So I worked on a grant project a few years ago that dealt partially with the pasture rangeland and forage insurance product. And we spent a lot of time with an insurance agent in Wisconsin, learning, similar ins and outs of how this works. And the question I have for you is, does it pay you to write these policies? Because it's a lot of paperwork for, for a relatively small payback. And the guy dealing with pasture, rangeland, and forage had kind of specialized in it a little bit and was promoting it and believed in the product and thought it was worthwhile. But man, it's a lot of paperwork. So, do you feel like it's worth your time to even do it?
This brought, you're right, you hit the nail right on the head. This is much more complex of a product, and the premium volume is not going to be there. We'd be looking at, if the revenue for the farm is always going to be $100,000, we're looking at pretty minimum premiums as far as, farmer paid versus other products. So I would say the best way, if somebody is interested in specializing in this from the agent side of the desk, it's going to pay if you get a bunch of them, right? Is it worth the time to write? If you're just kind of dipping your toe in the water with some of these products, you're kind of putting yourself at a errors and omissions situation, and that kind of thing. Me personally, if I could only work on crop insurance, I would. It's something that I find exciting, where most other people probably don't. But as far as the micro farm policy itself goes, whole farm revenue protection, it would be best to have somebody specialized in that and only that, to do, quite honestly, the best service to the farmer as well. But I don't know if those people are out there in the state of Minnesota specifically. It's just whole farm itself has not been a popular product, so I don't think there's many people who have worked with it enough to kind of specialize in it at this time. And I could be wrong. There could be agents in southern Minnesota that have wrote for other carriers that I don't know about, who just have a ton of whole farm revenue protection, but I don't know who they are.
Aaron, this is Kathy. Can an insurance agent choose to not write the policies?
You're kind of getting in a gray area, I would say there. So by the rules of crop insurance, if I'm an insurance agent and I offer a product, a whole farm revenue protection product to Dan, I can't tell somebody else no, right? Just because I don't want to deal with them and I don't like them. If it's not something you're specialized in, I don't think there's any issue turning it away to somebody else if you just really don't understand it. But you can't discriminate based on individual customers, but I would say you could discriminate on products. Like I don't understand that. I'm not going to write it.
I can see where that's kind of that systemic inequity that we often run into in our world.
Yeah.
Dan Mahoney, you're on. And thank you also for putting the note in about tomorrow night's session that Big River's offering with you. Is there any way that we can find out which insurance agents might be specializing in these products so that if our farmers wanted to pursue this, we could get somebody to do it?
I think we could ask that question through RMA because there is that risk management agency manages a agent locator database, but I'm not familiar enough with that database, and maybe you are, Aaron, of whether you can filter by product in that database. But I think that would be a really good question that we could ask RMA and follow up with the contacts that I have to see on that. Kathy?
You can filter it, but from as far as I know, that filtering is like multi-peril crop insurance versus somebody specializing in LRP, the livestock risk protection, or the LGM, the gross margin product. If you went and tried to filter that to an appointed insurance agent within 50 miles of whatever town you're in, it's just going to pull anybody who's appointed with a crop insurance company. I don't think you could get it specific enough to somebody specializing in whole farm.
Well, then it does look like we've got some public policy steps coming out of here that we should address. And even some just research, like we should go find the people that can write these, that want to write these, that are, want to become an expert in them, incentivize them if we need to, and to push it back. Like it doesn't really do any good for our USDA to say we've got a policy if no one's willing to write it. So that's kind of that, it's a pretty typical tactic. Yeah. Okay, any last questions, folks, for Aaron? Otherwise, we're going to give you back 4 or 5 minutes of your day.
Yeah, there's no.
Aaron, this is so helpful. This will be recorded. Jane will post it on MISA's site, and we'll follow up with notes and then the recording so that you can access it later. And then jump on Big River's session tomorrow night at 6, right? Yes. Okay.
Good deal. I'm glad it was helpful.
Oh, super helpful, Aaron. All right. Thanks all. Have a great one.